Welcome to How Do They Afford That, the podcast that peeks into the financial lives of everyday Australians. I'm Michael Thompson. I'm a writer and the co-host of the Fear and Greed Business podcast. And as always, I'm with Canna Campbell, previously a financial planner, now the founder of Sugar Mama TV, which is the financial literacy platform that you may well have seen on Instagram, on YouTube, podcasts, obviously like this one, books as well, plenty more. Canna, what have you been up to this week?
Not much, but I did come across a very cheeky savings hack, which I thought people would like to hear.
Well, considering about 4 or 5 weeks ago, you told us about how you tried to steal bananas from Woolworths. I think when they hear cheeky savings hack, I'm like, oh, what crime are you committing now? Let's go.
I promise you, well, maybe it's not illegal. Maybe
is
it's
it
not
not
legal.
paying for petrol? Because that is a crime. Just drive off.
The police will come knocking on my door. No, I saw this online. I thought it was cheeky but quite clever. When you sign up to a website and, you enter in all your details and they say like, put in your date of birth and we'll send you a gift card, every time it's your birthday, and it says, they might send you $30 off or $50 off, whatever it might be. Make sure you put in the 2nd of January and your year, because that $50 gift card or $30 gift card can then be used during sale season. You get more bang for your buck.
That's a great idea.
That was really clever. And I can't claim it's mine. I found it. I read it online.
And I'm not an expert, but it sounds legal.
Well, technically, it's probably morally illegal because it's a lie, because it's not your birthday unless it really is.
Okay, so if we have the scale of kind of tips, and at the extreme end of illegality, we've got stealing bananas from Woolworths. And now down the other end, which is more the moral scale, you're just putting the wrong birth date in order to give yourself more time for your voucher.
Exactly. And I have to say, I did also, as another savvy hack, is I signed up to Maya One.
Mm.
So I was doing some Christmas shopping and I was on the Maya website and I was, researching prices, and I noticed there were these like prices, and then there was the Maya One price, which for a lot of the items, and I was in the kids' toy section on the website, there was a big difference in price, like 30% different. And I thought, oh, there's got to be a catch here. You've got to pay $300 to sign up for this because these savings are quite substantial. No, it is free. And you enter it and it says, I think, sends you a birthday gift. It didn't say how much. I was like, there you go, 2nd of January. But you also earn loyalty points along the way, as well as accessing these discounted prices.
That's fantastic.
Yeah, really.
And I'm assuming you probably get kind of things like free shipping and stuff, because I've got to say, paying for shipping is just one of the worst things now. And there are so many ways around it.
I know.
You can often kind of, if you join a loyalty program, or if you just get it in one of their sales, or if you, and this is going to make the eyebrow go up, if you spend over a certain amount, I'm
not going to, I know, I do the same thing. I'm like, I am not spending $12.95 on postage.
I'm going to buy
something else.
Exactly. And you need it, and you were probably going to buy it in 6 months anyway. I'm trying to find a moral justification for this. And
no, you're safe here. There's no judgment, I promise.
Well, that's a complete lie. I mean, I have been...
That's your own insecurity.
Well, what about all my bank accounts? All the dozens of bank accounts that I had?
Judging. That's just like my passion for knowing there's a breakthrough around the corner when you start compartmentalizing and downsizing the 19 bank accounts, which are down to 16.
That's right. And they may well come down further by the end of the year. Now, we are talking about something that I'm really excited to talk about today, home loans. And not just kind of home loans as a thing. It is how to pay your home loan off a little bit faster, but also whether you can still get kind of a good deal.
Yeah.
In this environment that we're in at the moment, where interest rates are rising. Before we get into it, though, of course, anything that we're talking about today is general in nature. It's never personal, investment, strategic, or product advice. It is purely for financial education purposes only.
That's exactly right. We actually don't know anything about your financial situation, your financial goals, the deadlines to those goals, or even know what your risk profile might be. So should you hear anything and think, that's interesting. Is that something I should be doing for myself? Can you please go and talk to a financial planner and ask them for personal advice, which is then based on your own financial situation, your goals, your dreams, and of course, the deadlines you want to achieve all of those goals and dreams by.
So a lot of people have home loans. Feels like I'm kind of stating the obvious there to begin with. And so that means a lot of people over the last, say, 12 months have been feeling a lot of pain because interest rates have risen quickly in the last kind of 9-10 months or so.
I think we've had like 8 interest rate rises.
Well, this is the thing that, and I was doing a little bit of kind of
Google.
calculations. Just these are actual accurate calculations using an online mortgage calculator. And when you have an increase of a quarter of 1%, 25 basis points on, say, a $500,000 mortgage, that's another $75 every month. But we haven't just had one rise. We have had rise after rise after rise, and some of those have been half a percentage point. And so that actually means that, say, on a $750,000 loan, which, hey, if we were talking 5 years ago, that would be like, wow, that's a big loan. Now it's actually
that's the norm.
Yeah, that is actually the norm now. That means that you are finding about an extra $1,200 a month.
Yeah.
$1,200 more per month than this time last year.
Yeah. It's frightening.
That is a major shock to the system for so many people, because it's been 12 years, 11, 12 years since we've been in a rising interest rate environment. Where do you even start? How do you kind of factor that into your household budget?
Well, that's why you need to have a budget so you can understand, all right, where do we find that $1,200 per month? What can we cut down and what can we cut out to help fit this in so that we can still keep our head above water financially and keep going? But also, let's be honest, that we have more rate rises quite likely ahead of us. You know, this is not necessarily going to start slowing down or stop. So we need to be, prepared as best we can and look around as to what we can do so that we don't end up, defaulting on our home loans and looking at, foreclosure by the bank.
It's a lot of money to have to find.
Yeah.
And so how do you actually find that much fat in a budget? Or is it a case of trying to factor in kind of more interest rate rises? But most people don't have $1,200 a month of fat in their budget. So is it about now thinking about the side hustles and thinking about kind of where you can earn extra money?
It's a combination of the both. So it's looking at the budget and what can we cut down. And I think we'll really see people shopping differently, spending, not necessarily eating out in restaurants and cafes as much. We'll see people's lifestyles really adjust and shift.
Mm-hmm.
But then it's also about having a side hustle, decluttering, getting rid of the excess stuff in your home loan, which is something we talked about in previous podcasts.
Yep.
Looking at what skill sets you can use in your spare time over the weekends, early in the morning, at nighttime, to bring in some extra money to keep ahead financially. But also, I do want to point out, I know a lot of people who've been following my, financial education platform for a long time. I've always talked about not following the bank's prescription when it comes to your home loan. Try and pay more than the minimum. So those people who've been following that advice, and I know, Harry Hindsight never made a bad decision, and I'm being a bit of a know-it-all sharing this, but some people who understand the way mortgages work have been actually paying more than the minimum. So they haven't actually had, they've been paying that extra $1,200 per month. So they're not necessarily, or they've been paying extra $600 a month. So that they're not necessarily up for that $1,200 difference yet, because they've been paying $600 already extra. So it's really only X amount less, the difference, whatever it is between what they're paying, what they previously were.
But even those people now will have seen probably that excess eaten up.
Oh, definitely. And they're not seeing the debt come down as quickly anymore.
Indeed. And so they would have been getting ahead on their repayments and perhaps building up the potential redraw on their home loan. Is this a situation where you think we'll start seeing people kind of eating into other savings in order to start making those payments? Emergency money. Actually, remember how we've talked about emergency money before, and the fact that you need to have, if you can, have something put away for emergencies. Is the situation that we're in at the moment, with rates rising as quickly as they are, is this one of those kind of break glass in case of emergency situation?
It may possibly be.
Yeah.
And look, if someone has emergency money and a home loan, and I'm assuming that they're living in their home, it's their principal place of residence, having that emergency money through an offset facility rather than in an online savings account somewhere else may be more savvy, or maybe a more savvier use of that money, because it obviously, at least it helps reduce the amount of interest that they're paying. Because obviously whatever is in the offset account is offsetting the interest against the home loan. So that can be more efficient. But we're going to see lots of different things happen. And, some people I've seen have started, moving out of their home and renting their homes out to go and live in a more affordable area, so that they're not forced into having to sell their home. They can already see that the stress that it's putting them and their family under. So they're looking at not having to be forced into a situation where they have to sell assets, particularly as the property markets come off a bit, potentially having to sell for less than what they bought for. We're going to see, I think, all sorts of different things, but there are lots of different strategies and solutions out there to help survive and keep your sanity.
Yeah, it's a tough situation as well for people like that would be moving out and looking to rent instead, because at the same time, rents have gone through the roof.
And that's why I sort of say these people have, for example, moved into different areas where there is a difference in cost of living.
Yeah, okay. One of the things that we saw in kind of the last few years, it was a lot of competition between banks, and it was possible to get a better rate in many cases by ringing around and just talking to your bank. With rates rising, we're in a different kind of environment. Is it still possible to get a better deal on your home loan?
Absolutely, 100%. Ring around. Get a good mortgage broker, an independent mortgage broker, and that will be one of your best financial assets.
Okay, mortgage brokers. I was under the impression that mortgage brokers only kind of worked for you when you were just buying the house initially. Can you do it when you're looking to refinance as well?
Absolutely. And this is the value of a good mortgage broker. It's not about sort of turning and burning clients. They're about long-term sustainable relationships.
Gotcha. Yep.
So a good mortgage broker will, look around on your behalf and try and find you a better rate. And that mortgage broker will also go to your bank and say, look, can we get a better deal for my clients? They've been with you for 7-8 years. They've never defaulted. They're always on top of their repayments. They've paid it off. Can we give them a discount on their interest rate? So there are lots of different solutions out there. And I remember once I looked to refinance with another provider, and just as it came to, the final moment of signing the paperwork, the bank actually called me and said, look, we don't want to lose you as a customer. We're not only going to match that rate, we're going to beat it. So,
wow.
Yeah, that happens more often than not. And it makes sense because it's expensive for businesses to find new clients than to maintain clients. So you can definitely call your bank and ask them for a better deal. You can also shop around, and you can use the assistance of a good quality mortgage broker that can help you do that. And so that mortgage broker can not only set you up on the right type of mortgage, but also keeps an eye on it to help make sure that you're getting all the right loyalty discounts that you're entitled to.
Well, I did this about probably 12 months ago, maybe a little bit more just before rates started to rise. And I called up our bank, and before I did it, though, I did some research. I went and looked at some comparisons, used one of the comparison websites that kind of lists what other banks are offering. And so I kind of went into it with the information that I needed to ring up the bank. We've been with them for the last kind of decade.
Yeah.
And I have been banking with this bank. It's one of the 4 banks that I bank with. And it has been for the last kind of, 25 years. And so I called them up and just said pretty much straight up, I've been with you for a very long time. I know that I can get a better rate elsewhere, for example, here and here and here. What can you do? And it was all done with a phone call in about 10 or 15 minutes. And I hung up the phone with a lower rate that matched what I could have got at other banks without the hassle of having to actually go through the change process to go to another bank. I was kicking myself for not having made that call
ages ago.
Years ago.
I had someone message me this morning on Instagram, and she's someone actually I had interviewed for my podcast about a year ago. And she said, I've just gone and refinanced and we are saving $2,000 a month off their home loan. Now, I know from my podcast with her what her mortgage is. That was a phenomenal discount that she's had applied to her home loan.
Wow. So it does happen.
It definitely happens.
Even in this rising rate environment, there are still opportunities to negotiate a better rate. Maybe
you
not as many.
You can hustle a better rate.
Okay.
It doesn't matter. And don't also go by what you see on the website. That's not necessarily the best rate that you're seeing, online. It also depends on how long you've been with the bank, the size of your home loan, because obviously the bigger your home loan, the bigger the discounts because the economies of scale. There's so many different factors, obviously your employment status, what you've got in emergency savings, what other assets you might own. You might own an investment property or two. There are lots of different variables that come into this.
So before you make that call, because I think it's such a good call to make, these are the things that you need to kind of take into account or write down, even on a piece of paper, kind of what rates you found elsewhere, what the size of your mortgage is, and how long you've been with the bank, all of these kinds of things that you can use as your kind of script.
And quite often, and I'm not a mortgage broker, and this is not my area of expertise in any way whatsoever, but I was talking to my mortgage broker, who is the mortgage broker I've used and known for, like 20 years, I think. And he also looks after a lot of my clients. And we were talking about the interest rate environment and people being impacted and what people are doing. And he said quite often you're better off to contact your existing bank rather than to refinance, because the serviceability calculations that the banks are now running is around about 8%. So if you've already got an existing home loan, sometimes it will be easier for you to just stay with your bank and hustle them up for a better deal than actually go to a completely new bank, because the serviceability calculations are very different to what they were a year ago.
And serviceability calculations are in terms of kind of how much income you need to service your mortgage, that kind of thing.
It's part of the credit checking to make sure that they're obviously, lending money in a responsible manner, and they can demonstrate that even with further interest rate rises, you will still be able to keep your head above water.
On that front, how tough do you think it is at the moment for people who have bought houses or bought properties when the market was booming? It's come off a little bit in the last kind of year or so, but anyone who bought in the couple of years prior to that may well find themselves fully kind of extended.
Yeah.
There's going to be a lot of people in a fair amount of mortgage stress.
A lot. I think we will see some distressed sales. But then we still also have a housing shortage problem. So, look, I don't have a crystal ball, and I'm not about predicting anything whatsoever.
No,
I'm just looking around me and
look.
I look at what goes on in my own world and with my friends and so forth. But look, I think we'll see people go on more cost-effective, budget-friendly holidays. I feel like, people will start being more mindful in their shopping. Obviously, the discretionary spending, will come off. I worry about the gap getting bigger and bigger between people who have assets and people who don't.
Yeah.
Because it's harder and harder to get your foot in the door. There's so many different factors, and obviously we'll see a shift in assets. And people will probably consolidate. You'll see people who may have a principal place of residence with their family, but they also had a property that they owned when they were young that they still owned that was rented out. Well, I think we'll see people sort of reshifting assets where they might look at consolidating their debt to help pay down non-deductible debt. There's all sorts of different things. It's, again, that moving variables that we'll see play out.
All right. We'll come back in a second because I want to talk to you about kind of what people can do apart from calling up the bank. We're talking about kind of fixing part of your mortgage, kind of using your offset accounts, all those different kind of tools that are potentially at your disposal, with the ultimate goal of not just kind of surviving this period as rates are going up, but maybe even just getting ahead to hopefully pay that mortgage off a little bit faster. All right, we're talking everything home loans today. Obviously, interest rates have been rising a lot over the last 12 months. A lot of people under pressure, but the goal is still kind of there to one day be able to pay off this loan. There are a lot of different elements of it, and the media always talks about variable. The variable rate is the kind of the rate that people talk about. But the other side of this is fixed rates. How? Let's actually go through the basics. The difference between your fixed rate and your variable rate, and how does it actually work in terms of splitting a loan, for example, between the two?
Okay, well, a lot of people don't realize you can fix part of your home loan. Okay, so say I have an $800,000 home loan, I could fix, if I wanted to, say $500,000 and leave the remaining $300,000 on a variable rate.
Yep.
So there's a lot of flexibility. You can cut it different ways, and some people even cut it in different ways at different times. So they might have an $800,000 home loan, they'll fix $200,000 today, and then they'll go and fix another $200,000 in 6 months' time, and then another $200,000 in another 6 months' time, so that you've got obviously different variable fixed rates, because obviously those fixed rates move according to what's going on in the world. But also it means that risk of when those fixed rates expire, you've still got two more as a buffer there in place. They're not all suddenly stopping at the same time simultaneously. So that's a strategy that some people use.
Okay. And is that a conversation that you have with your bank about kind of fixing rates, and what time period are they usually across?
It varies from bank to bank, but you can fix for a year, you can fix for 2 years, you can fix for 3 years. One stage I saw you could fix for 5 years, but there weren't many products around. And again, I'm not a mortgage broker.
No.
So I'm going to be very careful to stay in my lane. But this is why you need to have a good mortgage broker or a great relationship with your bank, so someone can actually sit down and go through all the options and help work out what is right for you, because there are some limitations that come with fixed rates.
what are those limitations in terms of trying to pay it off earlier?
There's lots, actually.
Yeah.
A lot of people don't realize this. So, for example, with most fixed rates, there is a certain amount of money you can make as extra repayments, and it's capped. And it's actually quite low. You've got to read the fine print of your fixed rate terms. But normally it's between $10,000 to $15,000 a year as extra repayments.
Right.
So if you are someone that knows you're getting a bonus in 6 months' time of, quite a decent amount of money, it's going to be, say, in excess of $10,000 or $15,000, fixing your whole entire home loan may not be advisable. Okay, so you're limited to how much you can make per year on that home loan. And you also need to check whether it's per financial year, per calendar year, or per anniversary of your fixed rate mortgage as well. The other thing is if you go to sell. So say you suddenly want to upgrade or downgrade. If you're on a fixed rate, there may be break fees to pay. This is something I kick myself, and so does Tom, all the time. We actually fixed our rates at this ridiculous low rate. And then about 6 months later, we decided to move house. Now, luckily, rates had started moving, so we didn't have to pay any break fees because our fixed rate was actually so low, but we lost all those rates and we had to revert to the variable rate, which was substantially higher than this amazing fixed rate we had managed to lock in.
Yeah.
So you've got to be very, very careful of that. Also, if you want to go and refinance, because you go, well, if you're fixed and then all of a sudden the bank next door pops up with this amazingly attractive interest rate, you're going to pay a break fee to pay that. So you've got to be there are a lot of limitations that come from fixed rates. Also, if interest rates start going down.
Yes. Yeah, which no one really kind of thinks about now because all the movements over the last kind of 12 months have been up. But, I mean, you never know. You do never know kind of what will actually happen, and a lot can change in 5 years, for example. A
lot. And look, you can't, that's why I think with interest rates, you can't fix them for like 15, 20 years. But, some people love that comfort and that peace of mind of fixing their home loan, or at least fixing a large chunk of it. And fixing part of it can sometimes be very wise, but obviously you've got to be really aware and informed of all the risks and limitations of that, which means reading the fine print.
All right, offset accounts. How do they work?
Okay, so say, for example, I have a $800,000 home loan, but I have some emergency money. Say I have $50,000 set aside in an online savings account floating around in cyberspace. If I had an offset account, I would transfer that $50,000 into the offset account, and then it would be offsetting the interest on my home loan. So the bank would then calculate my interest not based on the $800,000 home loan, but based on the $800,000 home loan less the $50,000 on my bank account. So they're basing the interest and calculating it on the $750,000, not $800,000. Now, that may seem like a really small amount of money, but if you can maintain your mortgage repayments, it can help you save time and interest off your home loan.
Yeah, because you'll be taking more off the principal during that time. And that money is yours still. That's sitting in the offset account, so that if you have another emergency elsewhere, if say that is your $50,000 of emergency money and your fridge blows up, you can take that money out and buy.
Yeah, exactly. Still have access to it.
Okay. And then redraw works differently. That is the extra money that you have paid off your home loan that you can withdraw if you want, but essentially that is then just kind of putting your home loan back up.
And again, you've got to be very careful with some fixed rates. If you make extra payments within the allowed amount of your fixed home loan, sometimes, not always, sometimes you can't get that money back out.
Right. Okay.
I had a bit of a stuff up, and I once transferred, luckily it wasn't too much money, but I transferred some extra money into the wrong account, and I accidentally transferred into my fixed rate.
Oh, no.
And it was stuck. I couldn't get it out.
Oh, no.
It was about $800 or something, so it wasn't the end of the world, but I was like...
That's enough, though. That's enough to kind of go, oh.
I was annoyed, but I was like, okay, maybe it's just a blessing in disguise. And look, I'm sure I could probably call the bank and say, look, I've made an error, human error in transferring. But look, I let it go, and we ended up refinancing anyway when we moved. But you've got to be careful. It's not always what you think it is. You need to understand exactly what you're getting with any financial asset or tool or investment you're looking at. You've got to do your research and understand, make an educated, informed decision.
Okay, so to kind of pull it all together, there is so much bad news around there for people with a mortgage at the moment because rates are rising. What's the kind of the key to this in terms of how do you still get ahead in this environment? We've talked about a few different things. Is it about talking to your bank, getting a better rate if you can? It is about using the tools that are available to you in terms of, say, the offset account. It is about getting some good advice from a mortgage broker about whether you should be refinancing, whether it's feasible to do so, whether you can get a better deal somewhere else, because they are the ones who are actually going to know the situation. And is it also about treating your mortgage as the first not negotiable kind of part of your budget, that this is kind of the most important part to keep a roof over your head?
It should always be like that. It's a huge financial responsibility, a mortgage. There's a reason why not everyone owns their own home. So it should be like that anyway, but the answer boils down to a combination of everything. You know, this is not something you need to throw the towel in. There are lots of different strategies and solutions, and a couple of these things might help, but I really recommend this is a time where you should be looking at all of these things. You should be looking at your budget. You should be looking at what you can do to earn some extra money. Perhaps it's time to look at a new job, or going for that promotion, or looking at that side hustle, or decluttering, or looking at the way that you're living your life, or, thinking outside of the square, as well as looking at the interest rate you're paying on your home loan. Is it time to make that phone call to the bank? Yes, it is. Leave no stone unturned.
Yeah, you won't regret making a call like that. Even if you don't get anywhere, at least you've made the call.
You've got nothing to lose.
Yeah. Okay, look, I think we've actually kind of summarised quite neatly what we've covered today. Property is such a big topic, though, as well, and I think it's worth coming back in a future episode, because we actually had a listener request to talk about kind of getting your foot in the door in terms of in property, and a few different kind of tips and hacks in terms of building up that deposit, but also some of the mindset changes around it, which is you're not necessarily going to end up buy your forever home as your first house.
Exactly. You kind of have that waterfront property, with your boat parked in the mooring at the front and jumping in the sports car as you go to the airport on your second international holiday for the year. And we want it all. And we want it all right now, but there are stepping stones.
Yeah.
And, you need to be patient, you need to be diligent, you need to be focused, you need to be proactive. There's a lot of things that go into the journey and the process. Unless, of course, you win the lottery.
Yeah, in which case, have you ever seen anyone win the lottery and all of a sudden they just move to this glorious kind of mansion?
I can't remember the exact stat off the top of my head, but it's something like 80% of lottery winners end up being broke within a couple of years.
I reckon I'd do a really good job of spending $50 million. And I would actually use it to generate passive income.
Now you're talking business.
That's right. I listened to our last episode, which is definitely worth going back and checking out. All right. I think we've covered everything. How do we find you, Canna?
Best place and the fastest place is always Instagram at SugarMamaTV, because this is where I not only give you a daily dose of financial motivation, education, and inspiration, I also give you all the sticker tap links on my IG stories, where I'll tell you about what I've just published, and I give you the link to it so you can quickly and easily find it. And that is also the best place to get in contact with me. If you DM me, you're not getting a staff member, you get me who replies back.
All right. Thank you very much for listening to How Do They Afford That? Remember to hit subscribe or follow, and please leave us a review as well. Next week, we are talking all about risk profiles, particularly obviously as it relates to investing. It is a really interesting topic, so do not miss that one.